Hey, here we go. It's time to talk a little bit about Project 2, and let's take a look at maybe some of your specific companies. And I don't know if I'll hit them all today. We got a great list. I usually get a nice diverse list. I like doing this, and instead of assigning a company, let students pick. And every now and then, I know I've guided you maybe to look at some other companies, but it always intrigues to know what students are interested in, what companies they might be interested in, or products or services or those types of things. And so our list that I have this year, we've got Callaway, Christopher Banks, that's a new one, Barnes & Noble. Two of you chose Barnes & Noble, actually. Nike. Nike's probably the most common choice of all the companies that we've taken a look at through the years. Green Mountain. It's interesting. That'll be the first time to look at that. Brew, somebody, obviously picking a company just to try to suck up a little bit there. Picking a beer company, of course, but yeah. J&J, Johnson & Johnson. That was a big company. That one I'm a little bit concerned about. Guess. I'm not asking you to guess. The company guess. Apple, GoPro, and Buffalo Wild Wings. And I'll tell you, we got some companies in here that one at least go in a different direction maybe, and there's a couple companies in here that look like they're in maybe turnaround mode. So let's go take a look. Hopefully I didn't close out my Morning Star. I was looking at the last one on the list was Buffalo Wild Wings, and so I was taking a peek at that, and hopefully I've still got that up here. Maybe I'll pause and get it going. As we've looked at these companies, the main thing, and I'll type the ticker symbol in up here. You guys all know your ticker symbol, but Buffalo Wild Wings, and then it pops up for me, and so I can just click on it. It's already up there, but just to make sure you guys know and remember. And again, I'm not going to mandate that you use Morningstar by any means, but boy, I like this site. And through the years, I've switched. I used to use MSN all the time. I liked their site. They changed, and it's awful. Yahoo is probably a little bit more like their old site. I could never get into Google's financial research. I used to use Kiplinger quite a bit. Kiplinger used to have a good site. And I probably should go back and check on it some, but about 2 years ago, year and a half, 2 years ago, I stumbled on Morningstar, and have really liked the information that they provide. And I don't mind, once I've gotten kind of used to it, and I know it's brand new for you guys, but once I've gotten used to it, finding my way around on it's pretty simple, and it really, it gives us a lot of information, a lot of links to go places. And I think you'll do okay if you use this site along with annual reports and maybe a little other research. You'll do just fine on your project. Quick comment on the outlines. I kind of went through, and I don't think I've posted all the grades. I've read all of them. I've provided comments, but in some cases I haven't published those comments yet. I've just saved the draft. What was lacking in everybody's was any meaningful research yet into the financials. A couple of you put a little what I would call superficial information, and by superficial I mean the same things that I've asked for when I asked you to find financial information, or when I think I just asked you I don't hope. I know I'm gonna show you, I guess, some of the things I look at and glance at, and the things that I want you to most often. I want you to look for things that, but extraordinary things that your company, your chosen company, might have. Here, so I'm here to scroll down here, so I'm BSing a little bit while it's to do so, and I can't hardly get my cursor to work again. So I apologize for this. It's a little frustrating when this particular program just seems to use up a little too much CPU. So let me see if maybe I can pause it again here at least and try to get things working. So at all. Well, I'll talk a little bit about some of the stuff on here. This isn't a bad place, these key stats here for Buffalo Wild Wings. A few things you can look at there. It would be kind of interesting. I guess it's going to refresh, even though I didn't ask it to refresh. So hopefully it comes back even better than ever. We'll see. Yeah. Okay, it brought up the holy cow, it's going to refresh again. Okay. Well, let's see here. But it's not going to... Oh, there we go. Hot dog. I won't get rid of that. I like to come down here first and take a look at some things like, my revenue. Okay. And again, we're looking at Buffalo Wild Wings here, and so this just goes back 3 years. I'll take you to another place that's going to go back probably even further, assuming the company's been around longer than that. But look at this, and from 2012 through 2014, and for Buffalo Wild Wings, that's the end. Their year end is a calendar year end, the 12th month. They've gone from a little over $1 billion to over $1.5 billion, a 50% increase in 3 years. That's outstanding. Okay, that's absolutely outstanding. Okay, and so whoever chose Buffalo Wild Wings, I want you to tell me about that. Okay, I don't want you to tell. Let me rephrase that. Yes, I want you to tell me that sales increased 50%, but I want you to tell me why and how, and dig into it and ask what the company's doing. Is it what we would call organic growth, which means within the company itself, or did they go out and did they buy another company or something that might have increased their sales? Is it because of same store sales, or is it because they've been okay? And my guess is it might be some combination thereof, but that's going to be for you guys to tell me about. Okay, earnings per share. I'm not quite right. I mean, we've seen revenue go up by 50%, not quite 50%. Well, maybe it is. Maybe it's actually more than 50%, isn't? Income went up almost 100%, and earnings per share has gone up. That is more than 50%. So we've actually had. What are some things I can surmise from that? What I can surmise from that is I think our margins actually even improved. So in spite of the fact that we had such huge growth, okay, we also have had improving margins, which is a huge deal. Okay, again, we'll go look at some other things that might verify that, but those are, if you look at these things and kind of do a little bit of the math and whatnot in your head, it's kind of nice, and it leads you to find it'll lead you to more research that should help you write your paper. Okay, then a quick balance sheet, right? Well, what do we know here? We've got total current assets have more than doubled. That's wonderful. Non-current assets, they've gone up substantially, but not nearly as much as current assets. And total assets have had a nice increase, and liabilities have increased some, but it doesn't look like liabilities have increased as rapidly as assets. And so that's a big yay, right? Meaning that assets or equity, meaning that equity has increased substantially. We've gone from less than 400 million to close to 600 million. So pretty nice increase. Cash flow, we see some, cash flow from operations. We see that a lot of capital expenditures. It looks to me like a lot of capital expenditures. I'm not familiar with the company. Okay, my guess is when we go back up to this revenue number, that we're going to find that these capital expenditures are probably for additional locations. Okay, probably for additional locations, but for whoever's doing Buffalo Wild Wings, that's what you need to tell me. Okay, another great place. This whole line here, I shouldn't say absolutely this whole line. Chart you may not be interested in looking at. Stock analysis is just for premium members of Morningstar, so we're not going to get that. performance, there may not be much there, but key ratios you're going to come back and look at. Financials, some of these other things you may want to take a look at, maybe including bonds. I don't think bonds are going to be a big deal for Buffalo Wild Wings because I doubt they have any bonds. We can take a look here in a bit, but let's go look at financials. I can get rid of this, but I guess I can that way. Maybe we'll go look at financials. It's slow, 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 so slow. This gives us a longer picture, okay? So we had those 3 years, which is actually from here, 2012 to 2014. The TTM means trailing 12 months. So with their year end, they probably haven't got their quarterly report out yet, January, February, March, and so the trailing 12 months is probably the same as what their year end was, and it sure appears that way. And sometimes I do like to look at this in dollar figures. I think that's fine and dandy, but I'll also show you here where it says view, okay? I really like this because I like to change to the percent when I'm looking at an income statement. And I'll show you why. Remember when I said that it's impressive that not only did their revenues increase by a whole bunch, but their margins increased, it looks like. I want to verify that. Okay, I hit on this percentage, and I can come here and I can look at their cost of revenue. Well, their cost of revenue back here was about 73. It's actually gone up. Okay, so if you go back here, 73, almost 74, 73, 76, 76, close to 76. So their cost of revenue has actually gone up. So their cost of sales or cost of goods sold is what we might refer to that as, has actually gone up. Well, now we got to come down then and say, let's take a look at some other things. Look at this. Okay, their sales, general, and administrative expenses, however, went from 10 all the way up to 11, but now we're down to 8. So we've made some great improvement there. We're talking percentages here that look small, right? These are the things you got to get used to kind of looking at. And when we look at some of these other companies, especially some bigger companies like J&J maybe or Apple, you might even be looking at smaller changes in percentages, maybe 1%, but 1% when you're selling $1 billion or $400 billion worth of stuff or whatever it might be can be pretty impressive. Okay, so here we go. We've got sales and general administrative has come down. Other operating expenses, about the same. Okay, so operating income, it's actually come down. So their margins there have not really improved. But what about other income or other expense? A little bit. So income before taxes hasn't really improved. Provisions for income tax. So their net income as a percentage has actually stayed about the same. So I was wrong about the margins. It's kind of interesting then. I wonder how come their revenues could improve or their earnings per share. There's one other thing that could happen then. Maybe their shares outstanding have changed. Yeah, we'll see. Maybe they're buying back some stock. I don't know. We might have to go check and see on that. And that's made their earnings per share go up a little faster than what I would have thought perhaps otherwise. Although it's not a bunch, right? Because a 50% increase in this would take it to about 450, 460. So, I know I ramble a little bit because I get looking at this stuff. I just love it. I love picking these things apart and taking a look at them and seeing what's going on. So, okay, so I did that in percentages. Again, we can look at dollars. Remember, I said their cost of revenue this is why, looking at dollars when I'm looking at the income statement, wow, it's just, it's kind of hard to tell because their cost of revenue, the dollar figures have really gone up, right? But as a percent, it's only gone up a little bit. And actually their operating expenses, their sales and general administrative have gone down as a percent, but obviously it's gone up substantially as a dollar amount. So sometimes I like to look at percentages, but you'll see, then I go to look at the balance sheet and I actually prefer looking at dollar figures versus percentages. Because the percentages are, percentages of a total, and then it doesn't really tell me what's happening on the dollar side. So I know it's confusing, but mess around on them. come up and look at these and see what if you can figure out what I mean. Now here we're seeing, they had some impressive numbers here. By the way, 2011, things were so-so. 2011, we've seen a lot of companies kind of rebound from that. So we see, their total cash had actually decreased quite a bit, but has really come back nicely, right? And their total current assets have come back really, really nicely. Okay, so this company's generating some cash, and they're keeping it as current assets, right? Gross property plant. Oh, geez, are they investing in some new locations? Maybe they're just building a Taj Mahal someplace. I don't know, but the truth is, look at that, huge increases there. So my guess is, whoever picked this needs to figure that out for me, right? Are they increasing locations? I'm almost sure. Accounts payable, really not going up as much as I'd expect. Usually accounts payable, and a lot of you guys will find this, if you get really increasing sales, you'll see your accounts payable go up substantially, just because it's kind of a normal part of doing business, right? You're getting more inventory, more suppliers, those types of things. But they may be paying and taking advantage of discounts as much as they can. Accrued liabilities be kind of the same. You'd expect it to go up substantially. That's just things like accrued taxes, and so it's usually kind of commensurate with sales increase, as are other current liabilities, depending on what those might be. Non-current liabilities, so their long-term debt. This is a company that's growing pretty rapidly, and they've added, it looks like, a lot of locations and whatnot, right? Their gross property and plant has gone from 479 million to 856, almost doubled. And yet they've been able to do that without incurring hardly any more long-term debt. They got just a little bit of long-term liabilities, and those long-term liabilities total, right, are 84, and 40 million of that's deferred tax liability. And that's probably just a year-end adjustment that they're making. Other long-term liabilities, almost no, 44 million. I'll tell you, for a company this size, that's almost none. So stockholders' equity, you got additional paid-in capital here, and retained earnings. So they're not buying back stock. Yeah, that's interesting. In fact, what this tells you, I gotta go look at some of this stuff on this company. We got some interesting things going on there. But what this tells you too is, maybe that's what it is. No, okay. Usually, additional paid-in capital. Usually, your capital and the paid-in capital stay static, and we'll see that maybe if we look at a bigger company, I should say, not necessarily bigger, but a more mature company. What happens in some of these companies, and the reason we're seeing this, and I had to kind of look this up because it was kind of striking me as odd, but why we see these increases, it's generally probably a compensation thing. Because this is generally what we say is the original investment. The only reason we'd have additional paid-in capital is if we issued some more stock, okay? And a company that's generating profits like this company wouldn't really have a need to issue more stock, okay? What happens? They're probably issuing stock to employees, maybe management, and those types, and you're seeing that with a lot of newer companies. They actually do that. That's why I said more mature companies don't necessarily. So that's a good thing for a lot of you with smaller companies. Nike, if we look at Nike here, it's just huge, okay, in terms of what they've got for the additional paid-in capital. Retained earnings is just retaining the earnings that they're from year to year, and we'd anticipate here for Buffalo Wild Wings that'd be growing dramatically, and it is, right? They're just keeping all kinds, and so likewise the shareholders' equity is increasing just dramatically. So nice. I mean, there's some good things going on there. I said we'll take a look. Let's go click on bonds down here just for the heck of it, and see if there's anything on there. My guess, with only 44 million of other liabilities, probably no bonds. Yeah, no firm. The firm has no bond data available. So there's one example. I'm already taking up a decent amount of time just looking at one company. Just love it. It's just too much fun. And so we'll go look at Nike, though. This is a bigger company, right? And a more mature company. Nike's been around for a while. It's going to bring me up to the bond page, which is fine. Maybe we'll look at Nike's bonds here first. I would guess that Nike's probably issued some bonds. Not a lot, right? Debt, Amounts 1.3 billion. Their equity is 11.7 billion, so their total's 13 billion in their book value, I guess we would call that. But they do have some debt, okay, and not a ton. They're rated AA minus. That might be kind of important. AA minus is wonderful. Actually, the U.S. I believe is rated AA plus, the U.S. government debt. So Nike's almost as good as that. Looks like they've only got like 3 bonds outstanding, right? 1.1 billion. According to this is 1.3 billion, but according to this 1.1 billion. They might have some other debt that they've just borrowed from banks or other financial institutions that aren't bonds issues. Okay, maturity of 23, so that's only out what, about 8 years? Yep, 5/1 of 23, 8 years. This stuff matures then this year, so in October of this year. You might expect that the rate, think about your savings account, right? You get nothing for that, and so the rate on this thing is 0.42. If you want to go out to 43, which would be, how many years is that? Holy cow, 15, 28? How's my math? Yeah, that'd be right. 28 years, you could actually get 3.47, okay, percent from Nike. Okay, why does it differ from here? Remember we did those bonds, okay, and how they differ. Rates have gone up. You know, the coupon rate's 3.65, but rates have gone down some. Okay, and so the current yield to maturity is 3.47. So you'd actually, for a $100 bond, you'd actually have to pay $102.70, or if it was a $1,000 bond, you'd pay $1,027 for it. Okay, and this one matures then in 8 years, and you get 2.28% for that, which isn't too bad. That's similar to federal government debt. You know, they're fairly equal there. Of course, Nike's rated just about as good. So there's a little bit on bonds, and you guys should look at, each of you should look at your company, see if you got bonds. You know, see what the rating is, see what those types of issues might be. You know, if the rating is a little lower, you might find these yield to maturities are going to be a little bit higher. Okay. Let's go take a look at the financials here for Nike. Nike's just, I mean, they've been just on a nice run for years. This is a well-managed company. I'll tell you one of the negative things for, it was Aaron, I think, that chose Nike. One of the negative things that you find when you analyze a company like Nike is, you know, we're looking for some extraordinary things, and the company itself is extraordinary, but it's hard to look at their financials and say, wow, you know, everything's in place, everything's as it's supposed to be. You know, how am I supposed to find something to tell the instructor about? And it's tough. Okay, your task is difficult. Their year end is in May, looks like, so they'll have a year end coming up here pretty quick. You know, this is the trailing 12 months, but their year end looks like in May, and so, but look at, it's not growing as rapidly as Buffalo Wild Wings, but they've gone from 19 billion to in 2010 to 5 years later, you know, 28 billion just about. So pretty nice, pretty darn nice growth for a company that's this big, generating this kind of revenue. Okay. Again, I like to look at these as percentages. I like to see if they're making improvements, and this is a big company. Okay, this is a huge company, and so when we make percentile differences here, it can be really meaningful. And we see that their cost of revenue has, it was 54 here. It went up, quite a bit there, but they've been working to bring it back down. Okay. And so they've been making some marginal improvements in their gross profit. That's a wonderful thing. Their sales and general administrative expenses kind of went down through here, a little bit the opposite. So, it should have been. So they've kept their operating income, relatively stable. We got 13.5 it looks like on the high and 12.6 on the low. So 0.9 tenths, right, of 1% difference. You get down net income from continuing operations. Again, just dynamite, really, in terms of their operational control, their efficiency and effectiveness here, and being able to. Okay, so yeah, what do I talk about here? What do I talk about, right? Great earnings growth, earnings per share, la da da. Okay, there's not a lot to talk about on there. We might have to go look at the balance sheet on this one, and we'll do that as soon as my computer can upgrade it. And again, balance sheets, I kind of prefer to look at the dollar amounts. I think that gives us a better sense of where the companies may be going. And there's a couple things that were kind of interesting on here that I would tell Aaron. Probably want to tell me about, right? I found this one kind of interesting. From 2013 till 2014, they went through about $800 million. Looks like about $800 million in cash. And that was at a time when they would have generated, they had a really nice profit again. So they would have generated some cash. They actually kind of went through, more than that, quite a bit more than that. What did they spend it on? Is there some new initiatives going on? Hell, maybe it was just the donation that they made to the University of Oregon for their $73 million football training facility, and maybe they bought them some other stuff. I don't know, right? The answer could be down here though too. Look at this. So $5 billion, a little over $5 billion, a little over $5 billion. Ooh, gross plant and property. So we see a jump up to $6.2 billion. Might have answered my question, but I don't know. Okay, that's going to be up to you to tell me. But we see a nice jump up there. Okay. There's going to be a few of you that look at your companies and you're going to see decreases here. Interesting, right? So what's happening there? You're seeing companies that are selling off assets versus companies that are accumulating assets, like Nike is here. Goodwill, and Goodwill can be written off a little bit like depreciation. Goodwill is what you purchase. Sometimes when you purchase companies, Nike's probably purchased some companies in the past. And it's really the difference between the book value and the purchase price. Usually it's a positive. Intangible assets, probably things like patents, those types of things for Nike, and those probably lose some value over time as well. Deferred income taxes, that took a huge jump. I wonder why. Yeah. You might have to tell me. Okay, and I come down here, and again I see this huge additional paid-in capital, and that's a big number, and I'd like you to, Aaron, since this is yours. Their common stock has stayed the same, right? But their additional paid-in capital's been increasing dramatically, and tell me if that's really their compensation. I mean, that's a lot of shares of stock then that they're issuing. A lot of value, okay, partly because the stock keeps going up, but a lot of value in those stocks that they're probably issuing to management and whatnot. Old Phil Knight, right? Okay, and actually their shareholders' equity made a little bit of a bump down, in spite of having a good year, and so that's kind of interesting. So a little tougher to find some things when we're dealing with a big, more established company, but this would be of concern. I want to know about their additional paid-in capital. I want to know how come their cash actually depleted, right? And so I found some things, again, I'm clicking around looking for them. Key ratios is a great thing to click on. I'm going to have to quit after Nike here. I know I just get into it too much, but key ratios tells us some it even goes back further, right? It tells us where things have been going. Again, what an exceptionally well managed company that's just been churning out profit year after year after year, and you look at their cost of goods sold going way back, and those things have stayed pretty steady with this company, right? Not a lot of debt, return. Wow, just good numbers. You guys might want to click through some of these. With Nike, it's just solid. So go back to this original quote, just the quote on Nike, which we didn't look at. This is normally where I would start, but I'm kind of finishing up here. I'm doing Nike a little bit backwards. And there was something at the bottom of this, if I remember right, that kind of struck me as odd, that might have had something to do again with that here. Cash flow from operations, but they had big capital expenditures. Those jumped up pretty good. Okay, and so that's another thing, and that might be part of the cash deal, right? And so, Aaron, you might where are you going to find that stuff? It's probably going to be in their annual report. Their annual report should have good information about why their cash decreased and those types of things. And so the management discussion of those types of items will probably lead you to some good answers there. Here's a company that still had, free cash flow. That's amazing, of 2.1 million, and yet remember their cash balance actually went down a little bit. Interesting. I don't know why. And I'd sure like to know when I get done reading your report. Okay? I'll quit because I'd be here if I went through all of these great companies today, but I'm hoping that gives you a little bit of insight. Here's my best admonition is start early, start looking at your company for the finances, and send me a little deal. Says, what do you think about this? And I might send you back and say, well, that's cool, but take a look at this, right? And I'm more than happy to exchange ideas. I get plumb excited about exchanging ideas when we're analyzing companies like this. And I will plan to do this some more. I'll try to find a little time, maybe more than once a week, where I'll send out some Project 2 just examples.